A warm welcome to all of you to another live session at Best Ideas 2020. It's a great pleasure to introduce our next instructor based in New York. Sahm Adrangi is the Chief Investment Officer of Kerrisdale Capital Management, a private investment manager that focuses on value and special situation investments. Prior to founding Kerrisdale, Sahm was an investment analyst at Longacre Fund Management, a distressed debt credit fund. Sahm also worked in the bankruptcy restructuring group at Channon Capital Partners and the leveraged finance group of Deutsche Bank Securities. Sahm holds a BA in economics from Yale University. Our members will know and appreciate the ideas Sahm has shared with us in the past. Not just because of the quality of the research itself, but also those ideas have done tremendously well, and I hope that our members were able to take advantage of that. So on behalf of the MOI Global membership community, a very warm welcome to you, Sahm. Please go ahead.
Great, thanks, John, for the kind introduction. I feel like this is our 20th year presenting at the Manual of Ideas. We've been presenting many years, and some of the investments have worked out really well for us. So, I mean, for any investors that may have invested in them, but I think for us, it's sort of this conference has been a bit of good luck for at least one of our top investments each year. I think, maybe I can't remember each of the investments we presented on, but I want to say it was JLL 3 or 4 years ago. I think we did KFY, right? Yeah, we did KFY one year. I feel like we did U-Haul back in the day. But last year we did SE. And SE, that stock ended up tripling over the course of the year. Now, January was a great time to go along the market last year, but I think SE in particular, was able to see a sea change in terms of its coverage by the sell side and by the buy side community, and so it was a nice one for us last year. And we've got a new stock. It's our second largest position today in the fund, and so we're excited about the opportunity and hope it plays out nicely in 2020, 2021. A little bit on Kerrisdale. So Kerrisdale is an investment management firm based out of New York. We manage approximately $500 million in assets under management today. We're in our 11th year of operations. I'm the founder and CIO of the firm. One of the unique things about Kerrisdale is that on certain ideas, we'll share our research. And we share our research in a variety of ways. We post our research onto our website. We also distribute it via our email list, where we have about 7,700 subscribers on our email list. We also post it on Twitter. We've got 32,000 followers on Twitter. And if you want to sign on for our research, you can go visit our website at kerrisdalecap.com, and you'll see a subscribe button at the top of the site. And you can subscribe that way, or you can visit our Twitter handle and follow us there. Our Twitter handle is Kerrisdale Cap. We also post on Seeking Alpha when we have a big idea. I'll try to go on CNBC and Bloomberg. There's conference calls in some of our presentations, and when we have a good idea that we think the market isn't fully appreciating or understanding, we try to go out there and get our views more broadly distributed and dispersed, with the idea that if the rest of the market starts viewing some of these situations the same way we do, you can see the stocks revalue to their more appropriate valuations. So that takes us to today. Our long that we're going to be discussing today is Charles River Laboratories. And so let's just get started on CRL. So CRL is a dominant preclinical contract research organization. And what that means is when you look at the pharma landscape, both in terms of big pharma and smaller biotechs, through the drug development process, all the way from drug discovery at the initial stage, all the way through preclinical trials and phase 1, phase 2, phase 3 trials, all the way to FDA approval, many of those steps end up getting outsourced to third-party firms called contract research organizations, CROs. that specialize in certain parts of the drug development process and will run the clinical trials for either the big pharma company or the biotech. We've always sort of liked this business. You know, the end market in terms of biotech and pharma has been growing for a long time. There continues to be a lot of innovation in this space. You know, as these fragmented markets consolidate, the big players, you know, most of them have been publicly traded, you know, over the past 11 years while we run our fund, you know, continue consolidating market. So they're benefiting from end market growth as well as M&A opportunities to the extent, you know, they're effective in executing on their M&A strategies. And these stocks have been, you know, attractive holdings, and valuations have slowly expanded over time. We've owned a couple in the past, but our favorite today is CRL. And so Charles River actually focuses on the preclinical part of the drug development process. And what that means is these are the stages before phase one trials, before the molecules and drugs are tested on humans. Prior to those phase ones, you have safety assessment trials. You'll have the drugs tested on research models, lab rats, and other animals prior to being tested on humans. And Charles River originally began 40 or 50 years ago as a company that that outsourced these rat models for their pharmaceutical clients, and over time has expanded into other parts of the phase one preclinical outsourcing sector. They have triple the market share of Covance LabCorp, which is their next biggest competitor in the preclinical CRO segment. And you know, that size allows them to continue consolidating that market. As an example of how wide their reach is, they worked on 85% of the drugs that were approved last year, providing safety studies, toxicity analysis, animal models, and discovery services, where they focus on the drug discovery process for some of their biotech and pharma clients, where they help their clients discover the actual molecule that then, you know, the pharma companies move forward with. Their end markets are substantially larger than their current size, and we sort of break that down in this table below. On the safety side of things, where, you know, one of their sort of like strongest business, they have a 30% market share there. And you know, currently the market size there is $4.5 billion. They're number one rank. But when you look at discovery, the original drug discovery aspect of sort of the outsourcing market, their market share is only 8 to 10%, and the market size is $5 billion. And so, you know, it's that discovery segment that's growing in the low double digits and has, you know, particular opportunity within that DSA segment. You know, they've got three segments: DSA, manufacturing, and RMS, research models. DSA stands for discovery and safety assessment, and they're growing in both elements of that DSA category, but you know, the higher growth is in the discovery side of things. We'll talk a little bit about manufacturing research models. Their manufacturing business is actually in helping drug manufacturers conduct their quality control testing. And we'll talk a little bit about their microbial solutions testing business, or quality support business, and their biologics business. On the research model side, their original, you know, the original business of providing these rats to their pharmaceutical clients, there the growth is more flattish and low single digits. It's more of a mature market. They already have 40% market share, but that part of the business is only 1/5 of the overall Charles River revenue. It's a higher margin business, but you know, at this point, because it's a smaller business, that lower growth is less of a drag on the company's valuation than it may have been historically. And Charles River is still viewed by some people as a sort of a, you know, research model business, whereas in actuality, you know, the DSA and the manufacturing side of things are now sort of the big drivers of growth and larger parts of the business going forward. Here we have some of the pillars of our thesis. Safety testing is just 55% penetrated, and management thinks that we can reach 80% plus. There's an argument that there's no real particular reason why biotechs and big pharma out there need to conduct their safety assessment, their pre-phase 1 safety assessment testing in-house, as opposed to outsourcing it to Charles River or one of Charles River's peers. CRL has already tripled the size of its safety business over the past 5 years by gaining market share and acquiring competitors. We'll talk extensively about their M&A strategy, in later slides. And we think that growth still has room going forward as that penetration rate increases. That said, there's an emerging opportunity to really cross-sell their drug discovery services to the same customers for whom they're providing safety assessment outsourcing. Discovery outsourcing is a $5 billion market with lower penetration today than in safety, 25% penetration. And just 20% of Charles River safety clients currently use them for discovery services, and management targets cross-selling penetration of close to 50%. Recent acquisitions have added new product lines and geographic exposures. Cytox Labs supplemented their safety, their DSA business with a stronger European presence, and then their HemaCare business, allowed them to continue to push forward in the biologic space, the fast-growing biologic space of the pharma landscape. And that HemaCare business is growing at 20 to 30% top-line growth. And we think that biologics is an opportunity across all of Charles River's business lines, over the next 5, 10, 15 years. We also believe there's a margin expansion opportunity over the next couple of years. Management is a target of about 20% EBIT margins versus 18.8% today. And that margin expansion opportunity is part of what gets us to a 2021 EPS higher than where consensus estimates are. And when we put all this together, we get to a price target of closer to $200 per share today versus $200 per share versus the $155 that is trading today. And we use a simple 22 times 2021 EPS multiple of $9. And so both our EPS is higher than where consensus currently is, and the valuation multiple we're applying to that is a little bit higher than where Charles River is currently trading at. It's important to keep in mind, the growth of the end markets here. Charles River has, is dependent on research spending in early stage trials for both big pharma and biotech, but particularly for the smaller biotechs, which are, become over time the growth engine of the pharmaceutical industry. And, it's important, if we were to cite any risk here to the Charles River investment, it's that end market growth. And so if you see capital flowing into the biotech landscape drying up, VC funding drying up, that is a pocket of risk for Charles River if these end markets start slowing down. But we're tracking the end market metrics, on an ongoing basis, and we continue to see a healthy pharma landscape in terms of early stage clinical trials, R&D funding. We saw 7% growth in 2018 and 8% growth in 2019, according to Goldman Sachs, in terms of biopharma R&D spend, and Goldman expects that to expand to 10% in 2020. And then in the preclinical and early stage spend, that's actually compounding even more quickly than overall biopharma R&D spend. Biotech companies are sitting on record levels of cash, and the company provides nice data on this. But you can also sort of look at some of the sell side industry metrics that come out on a regular basis. And most of these biotech firms, don't have the internal toxicity staff, and the animal model inventory, and the infrastructure to conduct these preclinical safety assessments. And so outsourcing just makes a whole lot of sense for them. It ends up being a great business for Charles River. This is another slide on the end market growth. As we've seen, quarterly investigational new drug application filings have continued to grow nicely over time. There's an 8% compounded annual growth, and we think that that growth should continue. And with Charles River being the leader in producing high quality sterile genetically stable animal models, it's been able to use that animal model core to expand its safety business, and now use both its animal model business and safety business to further penetrate the drug discovery part of the preclinical CRO segment. So let's talk a little bit about discovery. Safety currently represents 75% of the DSA business, but the discovery end market, the discovery side of things is growing faster, and the end market's even larger than safety. Charles River's approach to growing that discovery services business, in addition to M&A, involves cross-selling. And so cross-selling, is drug discovery services to the same clients that are using them for safety assessment. We've got two pie charts here that demonstrate sort of the growth opportunity available in discovery outsourcing. In the outsourced safety assessment market, Charles River currently occupies a 30% market share, whereas in drug discovery, the top four that includes Charles River together on a combined basis only comprise 35% of that end market. So Charles River's market share is smaller, the end market is bigger, and so to the extent they're able to execute on that part of their business, we should continue to see higher growth in that discovery element of the DSA business. Next, we'll talk about the manufacturing support business. So Charles River's manufacturing support business focuses on quality control testing for manufactured drugs. So post FDA approval, when big pharma, either in-house or through their contract manufacturing organizations, are manufacturing the drugs, Charles River provides quality control testing and support in the manufacturing process. The segment consists of two parts: microbial solutions and biologics. The microbial solutions part of this business includes work on sterility work in microbial detection and endotoxin testing, and particularly their EndoSafe product, which is a recurring revenue business where they're able to continue selling cartridges to their end customers. And Charles River is currently in the process of upselling from their legacy EndoSafe business to their new EndoSafe rapid tests, which are priced higher and allow their customers to conduct their EndoSafe testing at a faster pace than the legacy product. This has been a fast-growing sector. It's been growing north of 10%, low double digits over the past 4 years, and we expect that sort of growth to be sustainable over the coming years. And we've got a quote here from the CEO: "Manufacturing support is only about 20% of our sales, but has been growing low double digits organically for a long period of time." The margins, this is a higher margin business than the rest of their segments, but management believes that these margins can continue to expand and get up to the mid-30s. And we expect that that organic growth to continue, as well as potential M&A to add to the growth opportunities there. I might want to take a pause and let Jordan jump in with sort of anything I may have missed so far on either the manufacturing business or the DSA business.
Sure. I think it's important to add that they've been very methodical with expanding into new markets over time. So as Sahm mentioned, they were founded over 50 years ago by a veterinarian who started off just running a lab selling those animal models. His son, Jim Foster, joined the company in the 70s and became CEO in the early 90s. He's still the CEO today. And he sort of went from just selling these animal models to running this safety business, which is effectively running all of the FDA-required preclinical animal safety, toxicology, and pharmacology testing that's needed before a drug can get into the clinic. And customers have a very high bar in who will choose for that, because once a drug is patented, the patent life starts running, and the 6 months, 3 to 6 months that it takes to complete one of these preclinical IND filings cuts into the patent life. And so we've spoken to many customers. They're generally willing to pay Charles River a premium, and we've even been told that Charles River is capacity constrained many times, and there's sort of a wait list to get into some of their labs for that safety business. So, the management continuity is there. He's been proven to sort of grow into these adjacent businesses, as he has for this manufacturing segment, which has been quite successful. And so that's why we think the discovery piece of the business can grow today. Only about 1 in 5 of their safety customers currently are using them for some sort of discovery service, but we think that can get to at least 50% over time, because they, the management team sort of has a proven track record of methodically expanding out, and now they have this collection of very high quality businesses that we think is generally lumped in with the clinical CROs, but we think these are actually much more differentiated, with some recurring aspects, with a little bit less project risk, because these are generally smaller projects. They're running hundreds of the safety studies every quarter, as opposed to a few big multi-$100 million phase 3 studies. So there's several characteristics that make this business stand out, even among the CROs, which are all in a generally high growth market.
Yeah, and we'll talk a little bit about that when we look at the valuation multiples that the sector commands. We think that this business should be, Charles River should be trading at a premium multiple to some of the CROs that focus more on the phase 1, phase 2, phase 3 clinical trials in the drug development process. Given that the clinical area is more competitive, there are more players. It hasn't been consolidated as much as the preclinical stages, partly through the work of the M&A strategy and the growth of Charles River. In terms of biologics, this is a fast-growing part of the pharma landscape. Charles River itself has generates north of $100 million from cell and gene therapy capabilities, and made a recent acquisition in HemaCare, which adds another $50 million of revenue in 2020 as part of its growing focus on the biologics sector. And biologic services include immunodeficient rodent models in their RMS segment, bioanalytical and quality testing for biologics, and cell bank manufacturing. While biologic and cell therapy spends only 5% of Charles River's revenue today, this is growing in the double digits, and it's a fragmented end market with assets trading for 15-20 times EBITDA multiples. We think that this is just an area of growth for Charles River, and the HemaCare acquisition is an example of management's focus on this end market. One of the things we like about Charles River, and which feeds into our arguments that Charles River should be trading at a premium valuation to the other CROs, is the low customer concentration. Given today its diverse client base, which spans across biotech, pharma, all the way to academics and governments, and includes medtechs and CMOs in the manufacturing business, as well as CRL smaller project sizes relative to some of the big phase 3 trials that the clinical CROs are more focused on. The result is a lower customer concentration for Charles River, and we show this in this bar chart here, where Charles River's largest customer is only 3% versus 5% for IQVIA, 9% for PRA Health, 11% for SYNH, 14% for ICLR. And so this lower customer concentration, provides reduced risk going forward for Charles River. One area that I'll highlight again, though, is that it's important to watch the biotech landscape and sort of the non-big pharma part of the biotechnology pharmaceutical landscape, because Charles River's focused on the preclinical side of things, has them exposed to these biotech clients. And management has made a focus to grow that end market relative to big pharma. High growth biotech clients have grown from 45% in 2014 to 70% today. And this TSA business is more than 60% of LTM revenue. And so, we think it's an opportunity because, we don't see the innovation in sort of these smaller biotechs ending anytime soon, but it's also something to watch for. One of the important parts of the Charles River story, especially when you're thinking about how consensus estimates are shaking out, has been management's competence and focus on M&A. Generally speaking, management likes to take the cash generated from its business to ultimately fund tuck-in acquisitions, in sort of niche areas of the preclinical CRO space, as well as their manufacturing support business, to continue to expand our capabilities and grow the business. Here we show organic growth versus year-on-year growth. As you can see, organic growth has been high single digits over the past 5 years, but when you combine the M&A, year-over-year annual growth has grown at a CAGR of low double digits. And we think that should continue to be the case. And it's really when you layer on some of the potential growth from M&A, which we think is a given, for this business, that's what gets us to our higher EPS estimates in the coming years. This slide further expands on that point. Charles River's history of high single digits organic growth and successful M&A have driven a 16%, 22%, 11%, and 23% reported overall revenue growth over the prior 4 years. And yet analysts are modeling just 8% revenue growth in 2021, even with the healthy biopharma R&D backdrop and the flush cash of many of these biotechs. And it's this potential additional accretion and revenue and profit from M&A that gets us to our higher forecasts. We also believe there's a margin expansion opportunity here. So there's been a number of factors that have depressed Charles River's margins, currently, and we think that those margins have room for expansion in the near term over 2020 and 2021. Number one, Cytox Labs, which was acquired in April 2019, earns lower margins than CRL's existing safety business of 15% margins versus 23%. And we think the margin expansion from that recently acquired subsidiary provides an opportunity for margin expansion over the next 2 years. As well, capacity expansion in Pennsylvania caused a 60 basis points margin drag in 1H 2019. As we move forward, that margin drag should go away. When we look at the overall peer group, clinical stage CROs, which we would argue is a more price competitive industry, given the larger number of competitors, already operate at near 20% margins and above. And so we would think that Charles River should be able to match or exceed that, given the more consolidated nature of the markets that it operates in. And management has been guiding to this margin expansion. And one particularly good way to see that is just tune into their September Analyst Day. That webcast is available on their website, and you'll see multiple times where both the CEO and CFO are expound upon their margin expansion opportunities. And they've sort of stated their goal of hoping to achieve 20% plus EBIT margin targets by fiscal year 2021. That compares to the analyst estimates of sub 20%, 19.5% 2021 EBIT margins in consensus models. Jordan?
No, I think what's happened is they've taken advantage of the strong demand environment over the past 18 months, and they've added a lot of capacity. So Cytox Labs housed global toxicity facilities, including those in Europe, and it's taken time for them to integrate those businesses, to transfer existing clients to those facilities, and so they've been operating essentially in these facilities at below the normal operating capacity. In Pennsylvania, they've gone from 2 to 3 facilities to house more demand in their biologics business, and that's just ramping now. So they basically, we think they have this backlog of customers. They've added all this new capacity, and as it gets filled, they're going to have very high incremental margins in that space. And so, we see a clear path to them achieving margins over 20% over the next 2 years, which on top of a business that's growing revenue in the low double digits after acquisitions, is going to lead to some very healthy above market earnings growth.
In this slide, we show the company's historical growth and our estimates for 2020 and 2021, as well as sort of trading multiples. We believe that there's going to be continued M&A, and that Charles River will supplement HemaCare acquisition with further M&A and discovery in biologics in 2020 and 2021. We think that these acquisitions can help accelerate the growth to Charles River's 12% target compared to the sub 10% growth rates being modeled by analysts. If you believe in the margin expansion story and you assume some of this M&A, that gets you to a $9 per share estimate for 2021. And if we use the CRO group multiple of 22 times, we think Charles River shares can approach $200 by the end of the year. And I think you can make an argument for a higher valuation multiple relative to the CRO group. And so then that would get you price targets north of $200, which is substantially higher than the $157, $158 that Charles River closed at today. This is another slide on valuation. Historically, Charles River's PE spread has been, to the S&P 500 has been higher than currently, and we think that this sort of premium to the S&P 500 makes a whole lot of sense for a business as attractive here as Charles River, and run by what we think is a very good management team. It's been the same executive team, and sort of certainly at the CEO level, for 20 plus years, and in our mind, this is a management team with a proven track record that has been able to pivot the business towards growth areas for a long time, and really know what they're doing. And as a management team, we're happy to be aligned with in a sector which is going to feature a lot of growth in the coming decades, probably. Here we show a comp set that demonstrates that Charles River trades below the clinical stage CROs, even despite the upside to forward estimates. So in conclusion, Charles River has leading market positions in high growth end markets. It's important to monitor those end markets, but the metrics we've been following have shown healthy R&D, IND filing, and early stage research spends across the board. In terms of its DSA business, Charles River has the opportunity to cross-sell discovery services to its existing safety clients and achieve those higher growth rates in the discovery part of the DSA business. The manufacturing business, where they provide quality control drug testing to manufacturers of drugs, is growing attractively, and now that part of the business is nearly 20% of revenue. And so as both the DSA segment and the manufacturing segment continue to become a larger part of the story relative to the research models business, we think that higher and higher valuation multiple becomes warranted given the growth prospects here. We note the low customer concentration and valuation multiples that are lower when they have been at certain times historically. And when sort of you put that all together, we get to a price target that is more than 30–40% higher than where shares are trading today. Anything else, Jordan, before we hand it over to John for questions?
That's it.
Okay, so that's our idea for 2020, Charles River, and John, we'd be happy to take some questions.
Great. Well, let's see if we can sprinkle some of our lucky fairy dust on this one as well. Just a reminder to everyone on the line, if you do have a question, feel free to type it into the online interface at this time. Sam and Jordan, on the topic of capital allocation, is there anything you'd like to see the management prioritize differently?
I personally like businesses where the management team takes cash flow and uses to consolidate the industry, assuming they have a proven track record of doing so. I mean, this sort of capital allocation strategy isn't for everyone. Charles River has a team that it's built up over time, focused on integrating newly acquired companies. The CFO does a good job tracking the return on investment on those acquisitions and discusses them in quarterly calls and during the analyst day. I think they're very intelligent and effective about, analyzing their M&A strategy and executing on it. This is an industry where consolidation can make a whole lot of sense, and it's worked well for other players, for other CROs in the past. It's worked well for Charles River in the past, and we think it'll continue to be effective way for them to grow going forward. Different analysts come out different ways in terms of what they want companies to do with their spend. But I personally like the fact that they spend a lot of the cash flow they generate on effective M&A. Jordan, what are your thoughts?
Yeah, I agree with that. As Sahm mentioned, they track return on invested capital religiously for these deals, so it's generally been above 10%. And in a world where they can borrow at 3 or 4%, getting a total return on of 10% creates very healthy equity returns. And this, I would say, Jim, the CEO, he's manically focused on growth. So if you sort of listen to him or meet with him, he thinks the business is all about growing, and that generally leads to strong returns over time. And we like the fact that he actually has a business where there are attractive assets out there, usually owned by private equity, because there's no real pure play public comps. So where you can go out and find these private equity owned companies, take that capacity, use his existing client base that has a demand for the service, that will pay a premium for the Charles River brand, and put those to better use. And so it's been an effective strategy. And I think with with Jim running the company, it's going to continue to be the focus of their capital allocation.
Yeah, when it comes to M&A, I mean, look, there's a lot of management teams and CEOs that don't do it well, just because it's not that easy. So I tend to be a little suspicious of new management coming in and trying to execute on an M&A strategy the way Charles River does. But when you're taking a CEO who's been at the helm for 20, 30 years, since the 80s, right? 91. I think he has a proven track record. He's built a team. They're intelligent about their M&A strategy. When you have that, it's one of my favorite types of capital allocation strategies out there.
You mentioned the management team has been there for a long time. Can you shed more light on their incentives and what you think their end game here ultimately is? I mean, could this company end up being an acquisition target itself?
Yeah, I'll take that. Again, it's the CEO, his father founded the company 70 years ago. So it's a family business, effectively. He owns stock, in the company's worked there his whole life. So I think the management transition conversation will come up in a few years when he turns 65. It is possible it could be sold. Covance, which is their largest competitor, Covance does both clinical and the preclinical work. They were bought by LabCorp a few years ago. So I do think one of the diagnostics companies, perhaps the tools businesses, and even private equity would be very interested in this asset. But I'm not, it's a question. It's really up to Jim and what he ultimately wants his legacy to be when he steps out at some point in the next 5 years, 5 to 10 years.
Yeah, I mean, this is sort of when you're classifying stocks, this is certainly sort of straight down the fairway, a compounder story. And I think, John, one of the reasons our manual ideas names have done well, that we present on this conference is partly because, I think you and the whole like MOI ethos brings out the compounder, side of us. And, as many of us know, at the end of the day, being cute about financial engineering or, buying companies just because they might get bought out or, whatever sort of like nifty gimmick that's out there for buying stocks tends to be not as great of a way of generating wealth as buying just a good compounder, a good business that grows year after year, consolidated its markets and has market size that are substantially higher than the current size of their business. And I think CRL falls into that category. And it's a stock you can tuck away, and I think over time benefit from the outsized returns that they're generating on the business and an expanding valuation multiple, and generate some nice P&L on this name.
What risk would be top of mind for you here? I mean, is there anything that could go wrong?
Yeah, so I've highlighted, the end market and the importance of following, indexes like the IBB and the XBI and R&D spending, among biotechs, the cash positions of biotechs, in a 2009 type of scenario, if overall liquidity is drying up and investors are not putting capital to work, one of the areas that they're not going to put capital to work in is biotech, high risk, high reward, area of the capital markets. And so, that's something that's important to watch. I think, 2 questions for Jordan. Beyond that, any other risks that you think worth discussing? And then I'd be curious, how does a business like this do in sort of a 2009 timeframe?
Generally, its clients have several years of cash, and so in an extended global recession, revenues will certainly decline, but they're still running projects. Big pharma is not going to shut off their entire R&D pipeline, and biotechs that have cash are going to keep running their projects until they run out of cash. And so while it didn't grow in 2009, it certainly outperformed many companies of its market cap. And in more cyclical recessions like 2016 and 2013, it can continue to outperform. It will say that the DSA business can be lumpy quarter to quarter, but when we're talking lumpy, it's either going to grow 3% or 9%, as opposed to having a quarter where it's just not doing any projects because the global R&D pipeline doesn't just shut off immediately. So we think it does have more consistency, but if we were to be in a period where biotech funding dried up for a year plus, they would be impacted. But I think a lot of other stocks in the market would be much more cyclical than this.
Great. Well, we'll have to leave it there, guys. Sahm and Jordan, thank you so much for taking the time to be with us again and for articulating your investment thesis on Charles River Labs.
Great. John, thanks for inviting us again this year. And best luck to everyone in 2020.
It's always a pleasure, and I do hope this has become somewhat of a tradition and that we'll see you again next January.
Absolutely.
Thank you all for listening. Goodbye for now.